Hey everyone, this is Kirk here again at OptionAlpha.com, and welcome back to the video trading recap that we do here on our membership side of the website. So for those of you who are new with us, again, we go over all of our trades that we make, both opening and closing adjustments each and every night, at least the nights that we actually make trades. And then for those of you who are not new with us or viewing this on YouTube, you're getting this video about 7 to 10 days after it's actually published just for our members. So if you're seeing this on YouTube and you haven't seen these videos before, you want to know how to get these alerts, you got to sign up at OptionAlpha.com. That's the only way you're going to get live trading alerts and these real-time videos. So today was actually a pretty active day. We closed out a significant amount of trades that we had for the month of March. And a couple trades for February as well, and then started to add some new positions on. But more importantly, we closed out a little over $1,000. I think it's actually a couple $100 over $1,000 worth of trades, at least on my end, profit and loss. And it's so important because I get a lot of emails from people about closing out trades during the month, and this is something that we actively do. So those of you who follow us know that we actively close out winners. But it's so important at times like these where the market just continues to rally, and we had been positioned for a little bit of a rally here for the last couple of days, that we actually take the time to close out the trades that we know are winners, right? The market gives us an opportunity to close out trades. We make a directional assumption that seems to be fairly right. Let's not flirt with disaster here and try to really stretch our gains and really squeeze out every little ounce of profit. So tonight I want to go over the closing trades that we had, why we closed out some of these trades so you guys understand those, and then also go over our new opening orders as well as the hedge that we had in J&J. But first, let's start out with VIX. Now, VIX is an interesting one. I had a pretty heavy position in VIX, and heavy meaning I was a little bit over what I usually do in VIX, only because I know that it's so downward focused during times like these, and I've gone over this a number of times in videos before. As we continue to add to the VIX position over the last couple of weeks, I continue to publish videos talking about how the VIX had made this similar type move numerous times before in the last year, and that we just have to play that type of move in the VIX. So today, with the VIX continuing to move lower, we closed out all of our short 17 calls. Now, we had entered some earlier and had added to that position later on, but in total, we had 6 short 17 calls that we closed out for a 35-cent debit. We made $110 per call, so there's a little over $660 that we made on the total trade as a whole. Now, this doesn't even include that we actually still have a short call spread on the VIX that's far out of the money and hopefully will likely expire completely worthless and add to that profit and loss. But just on that one trade alone today, we made a little over $660. So again, if you wait for your entry points and pick your points to make those trades, you get nicely rewarded for the strategies that you choose. So here's a chart of the VIX, and again, you can see the VIX dipped down back below 14, but what I want to highlight is, again, what I highlighted in the last video that we did when we sent out the alerts for the VIX, is that the VIX had made a very similar move numerous times before in the past. And it seems like every time it got up to this 21, 22 range, that the VIX actually continued to move lower very quickly before expiration. And we had that happen right exactly the same type of pattern. Now, this is not to say that's going to happen continuously like this, but right now we have 3 instances where the VIX has gone up to 20, 21 and continued right back down in very short order. So the next time it does that, you better believe that we're going to continue to sell strategies and option premiums around that strike range, around 21, 22, etc. Now, our strikes were at 20, our strikes were actually at 17, but because of the premium that we took in, we actually had a break-even point that was right around 19 or 20 or so. So that's really where we wanted the VIX to close below. But again, at this point, the VIX cannot really go too much lower, can go down below 14, but we're not going to eke out a profit for $35 on each position. We've made the vast majority of the profit to be made, so you got to close out the trade and move on. All right, so the calendar spread that we closed out today, this one we could have rolled to next month, but really there's no point. It actually was just a really beautiful calendar spread that we traded in IWM. This is a spread that we put back on a couple weeks ago when the market was really, really high. So when IWM was really hot, implied volatility was low, you go through our strategy guide that we have here published, you'll notice that one of the option strategies that we use when you're bearish and when also implied volatility is low is to use a put calendar spread. So that's what we did. We had a put calendar spread that was centered around the 110 strike. Now today we actually closed out that spread for $130 credit. We took in $55 of profit on each calendar that we sold back to the market. But really the overarching theme here is, again, the market made exactly the type of move that we expected it to make. We had sold this strategy up here near the top, not exactly at the top, but up very close to the top when implied volatility was low. And as the market ran down and settled near our strike at 110, it's a great opportunity to take money off the table. That's exactly what we wanted the strategy to do. So why would we continue to wait all the way through February expiration to then close out the trade and possibly see the market continue to rally or fall away from 110? Whatever the case is, the market did exactly what we wanted to do, take money off the table. And again, I know I preach this a lot, but it's really something I want to hone in on with a lot of the new people who are here, is that to be successful in this business, you have to learn to take money off the table. All right, so continuing on with this theme of taking money off the table, we had OIH. Now, OIH is oil, and we had bought a simple call spread, so the 44.46 call spread, and we sold it back to the market today for $1.50 credit, made $40 on each spread. So again, we sold back 6 spreads. You can do the math in your head. We made a very decent profit on this one as well. Really, same overarching theme here is that the market made the type of move that we expected it to make. We had the 40.46 call spread. The market continued to move higher. So again, we made this type of move here in the last couple days. That's really all we expect of this type of strategy, and it paid off. And since we had originally entered the strategy with a 50% chance of winning, by closing this trade out, we now make that 50-50 bet a 100% profit. So that continues to tilt the odds in our favor long term. Moving forward, COF and JP Morgan are very, very similar in why we closed out these. So Capital One Financial and then JP Morgan. Again, you'll notice that we had very long call spreads in both of these that we sold back. So we had debit call spreads in both of these. We sold both of them back for credits. On COF, which is Capital One, we sold them back for a $73 profit per spread. And then in JP Morgan, we sold that one back to the market for a $700 credit, made $142 on that spread. That was a little bit wider of a spread, so it was very simple and small. We only did one of those because it was such a wide range in price. We paid a little over $500 for that spread. So in that case, it's a big number, but it actually turns out to be a fairly decent profit all around. So hopefully, again, that you guys understand how we're taking these trades off, and you're continuing to see why we take trades off. Both of these trades, JP Morgan and Capital One Financial, and OIH for that matter, are all 50-50 original bets. So it was just a directional play. And now that the market gave us that direction, got to take the move off. All right, so let's go on to our opening trades here today. The first one that we have is a directional trade. Now you're starting to see that we're actually kind of retilting our portfolio, whereas we were a little bit long the last couple of days. We're starting to add some positions that create some downward delta or some negative delta in our portfolio, anticipating that the market could sell off here in a couple of days because it's just gone really high up after this last bounce. So starting to take off the profitable call spreads, which are positive delta, and starting to then add back some negative delta by vertical put spreads and selling call spreads, which we did today. So EFA is one of the ones that we bought today. We bought the 66, 65 put spread, so only $1 wide. Now we usually like to pay around 50 cents for this debit spread when the strike prices are $1 wide. In this case, the pricing was around 40 cents, and that was okay. So it's a little bit less, and that's fine. And that still brings our break-even point to just above where the stock price is trading right now. So that's actually a good thing. We go to a chart of EFA, and you'll see why we made this directional trade. Obviously, EFA has had a huge run back up in the last 6 or 7 days. So we're betting that from here all the way through March expiration, that at some point we're going to get downward pressure on EFA, and that will allow us an opportunity to take profits off and get rid of this trade. But more importantly, it adds a little bit more of the negative delta to our portfolio that we definitely need right now. We need to kind of rebalance out. We were heavily tilted not heavily tilted, but fairly well tilted bullish for this move, and that's paid off in huge dividends, obviously. But we need to now rebalance our portfolio just a little bit more. All right, so the trade that we have today on J&J, this one's actually a hedge, and it's a little bit different hedge. We're not doing this necessarily because we need the hedge. We're actually doing this because J&J actually just presented a really good opportunity to add to a current position that we already have. So we already have a put spread below the market in J&J, and what we did is we added a call spread above the market. So even though Johnson & Johnson has continued to run higher, implied volatility has stayed low during this whole time. So that allows us to go back in, sell the call spread against our current put spread position, basically creating a big, very wide, very fat iron condor. And that's what we did here today. So we went back in, sold the 92.5, 95 call spread, took in an $80 credit for the spreads that we sold. Since we already had the same basic type of spread on the put side as far as the number of contracts, which is here, and the width of the contracts, which is here, it didn't add any extra risk to our position. So we just added extra premium and therefore increased our probability of success. So I go to Johnson & Johnson just so you guys can see exactly where our strikes are. And I won't go to the chart here, but I'll actually go to the actual underlying security. So you'll notice down in the bottom left-hand corner and right-hand corner, you'll see our two positions that we have, both the 85, 82 and a half put spread, and now the 95 and a half, 95 call spread. Now we were already making money on the put side of the trade, so we just added to this call side position that we already have. Now notice that the actual call side just went into the money just a little bit here at the end of the day with a little bit rally up. We didn't actually enter the position at that, but just ended up going in the money. But the put side is well out of the money. And this helps our position tremendously because we have an opportunity now to close this trade out at a profit in the next couple of days and or roll this strategy up to help protect against this call spread that we now have against the position. So again, we didn't enter this position in the money, and I wanted to point that out here specifically on the video. It just happened to go in the money with the rally at the end of the day that the whole broad market had. But this is still a really good trading opportunity. Implied volatility is very high in the percentile range for Johnson & Johnson. So this makes a very nice wide iron condor that we should have on for basically the better half of February and practically into March. So as always, I hope you guys enjoyed these videos. Please ask your comments, ask any questions, and add any comments right below this video. I'll get to everyone's comments tonight or tomorrow, and happy trading.